Hi, Joshua Phillips here at Churchill Mortgage. It is April the 12th, and I'm coming to you with my weekly market update. Sadly, it was not a good week at all. We had the consumer pricing index that came out, and it basically showed inflation rising slightly. Year over year, seeing 3.5%, and probably everyone knows at this point the Fed's looking for 2%. So we are going the wrong way. That is not good for the 10-year Treasury market. That's not good for the mortgage market. What we have here on our screen here, if you've been watching these updates or if this is your first time watching the update, we've got a mortgage-backed security chart. This is where mortgage rates drive their values. All you need to know really is that red is bad and green is good, and the higher the price is, the better mortgage rates are, and of course the lower the price is, the worse mortgage rates are. And you can see here, boy, this is a Japanese candlestick. If you got some time and you want to just do a deep dive, ask ChatGPT about Japanese candlesticks. But basically what you're looking at here from a couple days ago is a very, very negative day for us. One of the worst days we've had in a long time, where mortgage-backed securities were down 88 basis points, which really means about a 0.25% rise in rates just on Wednesday, which is really where the majority of things fell off. And we are now looking at mortgage rates that are at the worst levels they've been this year. If I can pull back here to let's say if we can pull back to like a 6-month chart, get a little bit further view out. But again, whenever we see news that says inflation is getting worse, what that means is that the Fed's going to push out further. We started the year talking about 6 Fed cuts and maybe already having cut. That keeps getting pushed back and back and back. And now they're saying maybe 1 or 2 cuts by the end of the year. Not that Fed cuts are the same thing as mortgage rates, but they definitely have a good influence on us typically. So yes, so this is a 6-month chart. We can clearly see, as we've been over before in the past, where we were last October, we were way down, at a much lower level. And then we saw just a wonderful ride with security prices improving, mortgage rates improving as well, all the way up into January. And since January, we've just been kind of floating along and getting a little bit worse. And like I said, right now, rates are at their worst level of the year, and we're kind of retracing back to where we were, several months ago, back in maybe, November, December of last year. So now, what happens next? I have no idea. It really all has to do with what the future reports show. Is inflation going to come down? Or we really actually want unemployment numbers to get a little worse? We want the unemployment rate to go up, and we just don't know what's going to happen. I certainly hope at some point in the future we will hopefully see rates improve, mortgage-backed security charts looking better. But boy, this was a really bad week. Maybe we've reached a floor. Yesterday and today we're a little bit green. We kind of found a little bit of a support there. So maybe we'll hang on at that level and maybe we'll bounce back. That's certainly the hope. So hang in there. It is a rough time right now. And, still the silver lining is that it still might be a good time to be buying a home, because this is keeping housing demand down. Not as many people are looking right now. So I think that's the plus, is that it's keeping home prices down a little bit, and maybe giving you an opportunity to get out there and buy a home before everyone else jumps into the market. So, all right. Take care. Have a great weekend. Bye-bye.